This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Inflation ripples. Markets go risk on as the slowdown in U.S. CPI bolsters bets that the Fed is near the end of its hiking cycle. The IEA says global oil demand won't grow as fast as previously expected this year as developed economies falter. And Disney extends the contract of CEO Bob Iger for another 2 years, giving him more time to implement his turnaround and find a successor. Welcome to Bloomberg Surveillance. This is the early edition. I'm Dani Berger in London. Kriti Gupta is in New York. Kriti, the trade is still on. The disinflation trade, yields down, dollar down.
Yeah, and it's having a little bit of a ripple effect when you look at the stock market as well, specifically the idea that if you were looking at perhaps cheaper borrowing costs in the near future, plus a weaker entry point or a weaker way to hop into the stock market, aka the dollar, in theory, the stock market should go up, up, up. And that's kind of what's happening in futures right now, higher by about 0.4%, 45.23 for our radio audience on those contracts. But look, the bond market gets interesting here because, Dani, we're talking about this repricing. Perhaps we are near and closer to the end of the Fed tightening cycle. Although I have to say a couple days ago, that was not the narrative at all. Was higher for longer, but a 2-year yield is getting really interesting because already at 5 a.m. New York time, you are already seeing an 11 basis point move on the front end of the curve, 464 on the 2-year yield. The 10-year yield as well, same volatility, down about 4 basis points, and that's not even the biggest move of the pre-market session. So 381 there. It really speaks to the idea that this bond market is going back and forth very, very quickly. It reintroduces that bond volatility that I want to say was maybe missing in action for a couple of weeks, something to keep in mind as we go and really count down to that next Fed meeting at the end of July. I want to talk about Brent crude as well, because with that risk rally that you are seeing right now, you are also seeing the commodity complex get on board, and some of that might be a function of that weaker dollar trade that we are seeing, really following the bond market story. Anyways, Brent crude trading at an 80 handle, higher by 0.1%, Dani.
That risk-on mood is following to Europe. Despite some data we just got coming through, Kriti, the Euro area May industrial production data has come in much worse than expected. It fell 2.2% year over year. The estimate was for a fall of 1.2%. So we're not really paying attention to the Europe data. We're paying attention to the U.S. data. So we're looking at basically all regions on MapGo on your terminal moving higher this morning, carried higher by some of the higher beta type indices. DAX is up 0.5%. Even UK stocks, Barclays says that they're cheaply priced, but still, the risks are there. It doesn't mean you should necessarily buy this index. So FTSE 100 up again 0.2%. Now, I mentioned that worse than expected industrial data. One thing to flag in this European stock market today is the underperformance of BASF. That's down 0.4%. Again, that's notable while everything else rallies today. It is a chemical company and it has cut its guidance. It's yet another chemical company in Europe that's cut its guidance. Langness also cut their guidance. Look, it's a bad sign because chemicals are used in literally everything, especially industrial companies. So it's not a surprise industry of Europe is lagging in the data we see. Elsewhere, it continues to be that inflation trade, Kriti, the disinflation hopes. We're looking at German 2-year yields, Schatz. That's getting bid today. We're down about 8 basis points. And sterling versus the dollar. I know we're about to talk about this trade with Valerie in just a moment, Kriti, so I won't go on too long here. But we're at 130, back above 130 for the first time since April 2022.
You know, it's interesting that you mentioned that chemical sector in particular, because, of course, Europe is going to have way more exposure to that than the U.S. will. But still, the ripple effects are going to be interesting when you look at those pre-market movers. But again, at the core of it is just how expensive things are getting, which brings us to the top story. U.S. inflation sharply cooled last month, offering fresh hope that the Federal Reserve can soon wrap up the most aggressive interest rate hikes in decades. Bloomberg guests weigh in on the data and its implications for Fed policy.
This was a good report.
An extraordinarily good print for the Fed.
The Fed should be pretty cheered by this.
Disinflation is starting to take hold.
But I don't think it changes what they're going to do at the July meeting.
I don't think it changes the move in July from the Fed.
I think the Fed will hike in July.
They can't take their foot off the pedal yet.
Could July be the last one?
If this is the new run rate, then yes, it would call into question hikes beyond July.
They won't move at the meeting after July. They'll take a break just like they did this last time.
That September hike is one where, you know, they could afford to skip again, given the way inflation's sort of behaving right now.
And then we're going to get to November 1st. Well, there's a long time between now and November 1st.
There's a lot of time between now and November.
The November rate hike is really up for grabs at this point.
Joining us now, Bloomberg's Valerie Teitel to walk us through it. Valerie, look, we're still waiting for PPI data. We got some positive numbers, perhaps, when you look at the core or the super core, if you'll nerd out with me there. Walk us through this trade that we're seeing right now.
Look, it is immaculate disinflation. We're seeing inflation fall in these sticky components without any labor market pain. The follow through today, especially in the London session overnight, is notable. That two-year yield sinking another 10 basis points. I was just checking on my Bloomberg screen. It's dropped nearly 25 basis points in the last two sessions. The thing that stuck out to me is on this chart here, Kriti. Let me go over it quickly. The Fed funds rate is now trading above core inflation for the first time since 2019. Now, this is notable for markets, and this is a signal that the cycle is nearing an end, because Powell has really drawn markets' attention to this narrative around a positive Fed funds rate, around positive real yields. And with yesterday's weak inflation print, we got there.
We also got UK GDP data in. And I mean, the UK economy continues to stand out for, I guess, its resilience, but not necessarily in a good way, beating expectations. What does this portend for what it means for the UK inflation story versus that of the U.S.?
Yeah, a slight beat when it came to that GDP print today. And it comes along, maybe a string of positive, more positive than expected data prints from the UK. All I can say is that when I look at my Bloomberg terminal, I'm really happy that gilts are following this Treasury move. They're not necessarily reacting to this positive GDP data like we'd expect, but we're seeing, an 8 basis point rally across gilts. And cable is strengthening, that's basically following on from dollar weakness. But again, this is not the time that the UK needs to have a string of positive economic surprises. But we say that with the guys that now we know. Well, I don't want to say we know, but now we can assume the Fed isn't going to 6%. Yeah. There's going to be a little less pressure on the Bank of England to get to 6.5%, 7%. I know we've had some quite crazy numbers from the street thrown out about how high they have to hike. So possibly a bit of pressure off the Bank of England because the pressure is now off the Fed. But still, it's about that core CPI print we get next week. My eye's going to be on that UK inflation print next week.
Certainly something we're going to be keeping an eye on. Bloomberg's Valerie Teitel all over the trade on both sides of the Atlantic. Now, what's interesting is what she was talking about with the inflation story, because remember when commodities was driving inflation? Well, it's not anymore. Global oil demand especially not planning to grow as fast as previously expected. That's according to the latest report from the International Energy Agency. The head of the IEA's oil market division spoke earlier on Bloomberg.
We're seeing weakness, especially in Europe. As the manufacturing remains weak, we're also seeing some negative sentiments in China. But Chinese demand has been holding up very strongly. And now the expectation for this year is that Chinese oil demand growth will be 1.6 million barrels a day. And that's 70% of the global total. So while the economic outlook for China remains fragile, the recovery is losing steam.
Joining us now for more is Bloomberg energy reporter Anthony DePaolo. Anthony, walk us through this. What happened to the oil demand supercycle narrative of, I want to say, even a couple months ago?
Yeah, that demand is still increasing. We are going to hit a record demand this year as we're recovering from COVID, getting back past those 2019 levels. So we are increasing still there, but just not as quickly as had been expected earlier. Now, a lot of that comes down to, as you guys have mentioned, the fears and the concerns about economic weakness in the West, and that sluggish recovery in China. The market is still looking at China for needing that recovery, bringing in more oil there, and that's really one of the keys that will pull this oil market along. And we're seeing that happening, but at a more sluggish pace. So traders are still watching that. They're still concerned about that. The increase in Brent crude over 80 yesterday just really underlines how much traders are watching the Western economies. It was that slower than expected inflation that came out from the U.S. yesterday that kind of really pushed oil above 80 for the first time in a couple months, really. So that was what was seen as the positive news there, Kriti.
That $80 a barrel, that's not the only thing that caught our eye. Also $60 a barrel on Urals on Russian flagship oil, which of course is above that price cap set by sanctions from G7 nations. Anthony, if we've seen Russian oil prices go above that price cap, does that mean sanctions just aren't working?
Yeah, Danny, well, that creates an issue for some of those buyers that have been taking a lot of the Russian crude because they need it to be below that price cap in order to get all the services from G7 countries like shipping, like insurance, and that makes those transactions basically free of the risk of sanctions from the U.S. on those transactions. So when those transactions go over the price cap, that's where they get at risk, and potentially some of those buyers will have more difficulty doing those deals. Now, we've spoken a lot about this so-called dark fleet, a group of tankers that are outside of the Western insurance system, that are maybe owned by Russians or other companies that are taking those barrels without needing these kind of Western services. So potentially there's enough there to continue carrying that oil. A lot of the traders that we're speaking to expect China to continue taking a lot of those barrels. India has been taking a lot of Russian oil as well, and perhaps there's some issues there. They don't want to run afoul of those sanctions, but again, they want to keep getting those cheaper barrels and continue making sure that the oil market is well supplied. So this becomes an issue, but we'll see again how that Russian crude reacts and whether it stays above the price cap. The main thing has been to kind of keep Russia from getting those higher profits from the high oil prices. That's been marginally effective, so we'll see how that continues going on now that we have breached that price cap, Danny.
Anthony, thank you very much. That's Bloomberg's Anthony DiPaolo there. Let's talk about Disney. It's extended the contract of CEO Bob Iger for another 2 years. The company announced that Iger will remain in the top job through the end of 2026. Joining us now is Bloomberg Quick Takes Alex Webb. Alex, Iger's been very successful, hence why they're keeping him in, but I guess successful at everything except finding a successor.
Yeah, successful succession. I mean, that's ultimately the two reasons why they're keeping him in. Investors like him, studio seems to like him. He's very astute and adept politically. His predecessor and previous successor, Bob Chapek, ruffled a lot of feathers while he was briefly in the role. But the fact that he's extending from the end of 2024 to the end of 2026 indicates they don't really have a clear successor in mind, or if they do, they possibly think that person needs more grooming. We don't know who it might be. So it's very much sort of mixed news for investors. They like Iger. They would also like to have probably a clear idea of who his successor is.
Well, Alex, talk to us about the Disney kind of business model here. You know, we talked about how well-liked Bob Iger is. I think he's extended his contract in his first iteration as CEO 4 times before then being reinstated, as you just point out. The market clearly likes him, but what exactly do they like about him? What piece of his leadership or strategy is really appealing here?
Well, on the one hand, he is very adept politically, as I said. Secondly, he has a pretty clear vision about what the studio should be, how it should be making money. He made some very astute acquisitions over the course of his time. First stint at Disney, think about Pixar, Lucasfilm, Star Wars production house, and of course Marvel, which has become a behemoth. But he also managed to pivot Disney at the right moments. Disney was a company that had, quite a healthy dividend for much of its time. He started piling into Disney Plus just at the time that Netflix was doing really well. Now, that was a slightly poisoned chalice, of course, because it meant that Disney, look at that stock chart we just saw, it did very, very well during the lockdowns because interest rates were low. That meant that people were searching for growth. Disney Plus was growing really quickly. And, of course, consumers had the time to watch Disney Plus. As the heat slightly came out of growth stocks and interest rates increased, Disney was perhaps in not a very good position. So he's now starting to pivot back towards that dividend-paying business, which is something that activists have been asking for as well. So it's that affinity for what the capital markets want, as well as a firm grasp on the strategy of the rest of the business.
Alex, thank you very much for that update. That is Bloomberg Quick Takes Alex Webb. Coming up, we're going to talk about this macro environment after yesterday's CPI numbers. We'll be speaking to Skylar Montgomery-Coning, global macro strategist at TS Lombard. And with inflation still not low enough, workers are looking for more money in their pockets. We're going to be discussing the high-profile labor actions taking place from Apple, UPS to Amazon, and what it could mean for inflation going forward. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Look, Dani knows this well. I get obsessed with certain stories, certain dynamics in the market. It was regulatory last week. This week, it's all about labor, especially in the show, which is handy because we just got some super core data that is truly historic. It's actually, we're seeing the first monthly drop in the super core numbers going all the way back to mid-2021. Now, you might ask, what is actually in this basket? Because, hey, I did Google it before the show, and it's really all about the services sector, things like medical care, transportation, education, even garbage collection, essentially a lot of the sectors of this economy that are really reliant on things like labor, except if you actually look at the inflationary story, it doesn't look like wages are coming up. Now, if you are earning and inflation is high, you are, of course, making fewer real wages. Your dollar goes further or less far, I should say, or whatever currency you're trading in or buying in. You can tell I'm a financial journalist here. What's important to keep in mind is that the wage story is not keeping up with the broader inflationary story. It's a theme we're going to discuss in the back half of the show. The question is, what do you do with seemingly positive information like that? Let's bring in a true expert. Bloomberg's Eddie Vanderwalt has all the answers for us. He's our deputy managing editor over on the Markets Live blog. Eddie, does the wage data or lack thereof matter here?
Yeah, way to set me up to fail, Kriti. Thank you very much. Look, that supercore number is really, really interesting. It is coming down. That is undeniably good news. It is coming down too slowly, and it is still too high, right? I think when I look at that number, what I see is, yes, the Fed is going to hike in July because they said they're going to hike in July. They're probably going to pause a little bit afterwards and see how much it's coming down. But the reason we look at supercore is that is the most sticky part, the most, the one that tends to change the slowest. And that is still well above where the Fed would like to see it. As long as that remains the case, I think there are still further hikes further down the road.
One of the consequences of the CPI number yesterday has been this massive tech rally. We also see it in Asia. But Eddie, one of the things that I'm trying to figure out, and I know you saw this story too, of more positive sounds from policymakers in China around tech. I mean, a lot of China stories. We also had weaker exports. How are you reading China tech today?
Yeah, I think this is part of China wanting to stimulate, right? Because I think the policymakers, I think the authorities there are saying, look, our economy is getting hit from all sides. Maybe the tech sector needs a bit of a break, right? And I think that's what they're doing. They don't want to go all in at this point and put more pressure on the tech sector. I think that's quite a positive development because I think Europe needs a strong China to get back on the front foot. So if China just takes a little bit of pressure off the tech sector, which is what we're seeing at the moment, that could spill over into European stocks too.
Well, Eddie, talk to us about the read-through there, especially not just from kind of a regulatory or kind of a even post-COVID policy, but more from a infrastructure stimulus kind of policy. Does it matter what, say, the PBOC does, for example, for a U.S. or a European market?
It definitely matters. I think I was speaking to colleagues here in Bloomberg yesterday, but just about how China stimulates and whether they will be successful. The big question, there's really two questions to answer here. Number one, will they bring that broad-based stimulus that will fuel the whole of the economy? Number two, will it be successful? And I think I don't think it's absolutely certain that either of those two will get a positive answer in the short term. I think China is a little bit worried, but I think at the moment what we're seeing in China is the weakness is focused on the manufacturing sector, and China's much more focused on the services sector and on the consumer demand. And consumer demand still, fairly strong in China at the moment.
Eddie, thank you so much for joining this morning. Always a pleasure to speak with you. That is Bloomberg's Eddie Vanderwalt. And for more market analysis from Eddie and the team, MLive Go is where you want to head on your terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London with Kriti Gupta in New York. Now, some of the top corporate stories we're watching. Carlyle and TrueStar are said to be seeking a partial exit from McDonald's China in a deal that would raise $4 billion. GIC and Mubadala, the Abu Dhabi Sovereign Wealth Fund, have been approached about the deal that values the entire business at up to $10 billion, including debt. A lot of different thread here here, Kriti, to dissect. One of them, look, it has been this trend of American firms trying maybe not to be so closely tied to China, or at least exit part of their holdings in the region.
Yeah, let's put some numbers on it here. I mean, a record year in 2021, and we kind of knew that post their COVID policy. The value of exits in Asia, in the Asia Pacific region, has plunged 33%. It's only at about $132 billion as of last year. So it seems like a big number, but relative to what it was, it is declining.
Yeah, and look, another thread that we're following is what's happening in the agricultural commodities sector. India, which is the world's biggest rice shipper, is considering a ban of exporting most varieties of rice because of rising domestic prices, and authorities want to avoid the risk of more inflation. Now, this move may already send lofty global prices even higher with the disruptive El Nino weather pattern returns. Kriti, I'm like, inflation, okay, I can stomach it, but not my rice. Please don't make my rice more expensive.
Well, this is important because India, of course, is one of the major exporters, and this idea of protectionism in an era where food prices are still very high in a lot of different countries is pretty interesting. And I wonder what kind of trend it sets for a lot of the other countries, including the United States, that is also a major exporter of food. India for rice, but the U.S., for example, for things like wheat and grain.
Yeah, and it might be this further divergence of U.S. inflation comes in, but pain elsewhere in the world. We're going to talk about that theme and more with Skylar Montgomery Koning, global macro strategist at TS Lombard, coming up next on Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Inflation ripples, markets going risk on as the slowdown in U.S. CPI bolsters bets that the Federal Reserve is close to the end of its hiking cycle. The IEA says global oil demand won't grow as fast as previously expected this year as developed economies falter. And Disney extends the contract of CEO Bob Iger for another 2 years, giving him more time to implement his turnaround and find a successor. I'm Kriti Gupta in New York with Dani Berger in London. Look, Dani, I feel like the hot day to watch on the eco front was yesterday, although a lot of eyes on PPI today as well.
Yeah, and jobless claims, right? Is it still going to be really strong? Is this still a hot labor market? Is this immaculate disinflation in the works? At least here in Europe, we're still trading on that theme. Nothing to interrupt what happened yesterday. We're continuing to buy equities in Europe. The European stock 600 is up about 0.6%. I did want to flag one story. BASF, the chemicals company, cutting its production forecast, not production, I should say, cutting its forecast in general for demand late yesterday. So we're seeing it underperform. Most things are rallying, hence it's only down about 0.05%. But still, it's troubling for Europe, for chemicals, for production, for kind of everything. We also got European industrial production data just about 30 minutes ago. That also came in weaker than expected. But elsewhere, yeah, it's this continued disinflation trade. Schatz are getting bought. German two-year yield, those are down 7 basis points. And meanwhile, it's basically sell the dollar against everything. Sterling is stronger by about 0.5% versus the dollar. We're back at 130 for the first time, Kriti, since April of last year.
Yeah, the dollar weakness is really interesting because it is having ripple effects stateside as well. Take a look at futures, for example, 45.23 on those contracts, stronger by about 0.4%. Now, the idea of the inverse correlation between the dollar and the S&P 500 is starting to seep back into the narrative as we kind of see this fresh wall of cash, not from people within the U.S., but from around the world, perhaps entering this next leg of the year. What's interesting is that the pullback in the dollar is really coming from the bond market story stateside. Take a look at the two-year yield here, already at about 5:30 a.m. in the morning, New York time, down about 10 basis points, 464 on that two-year yield. Again, bringing back the concept that maybe the Fed is about to end its tightening cycle. That doesn't necessarily mean they're going to be cutting, though, and I think that's an important distinction to make. The 10-year yield, of course, at 382 following that lead, although I have to say, pairing some of the earlier move that you saw, it was down almost 5 basis points earlier in the session, now down, we'll call it about 3. I think a big question, though, is not just the inflationary story, but it's the recessionary story as well. And if Brent crude is going to be kind of our proxy for gauging how close we are to that, no signs here yet. 80 handle, Dani, on that commodity.
Let's talk more about the CPI numbers, Kriti. And Senator Elizabeth Warren is calling on the Fed to halt interest rate hikes as U.S. inflation slides to more than two-year low.
We have great news today that inflation has been cut by 2/3. So my message is take yes for an answer, Chair Powell, and let's stop with the rate increases. Done.
Done. Is it done? Let's get over now to Skylar Montgomery Koenig, Senior Global Macro Strategist at TS Lombard. Skylar, is it one more and done for the Fed?
Yeah, I mean, we've definitely transitioned to the phase of the tightening cycle where the Fed is attempting to be gradual. They're trying to assess the impact of tightening and what they've already done. And we all know that monetary policy works with a lag, but no one, the Fed included, knows how long that lag is. And I think what we've seen is that the U.S. economy is much more resilient to a higher policy rate than we expected. At the same time, the U.S. has made this remarkable progress on inflation. The latest print is certainly a sign of that, but we've seen 4 months of negative inflation surprises. This has clearly been the trend for a while. And in response to that, the market's essentially priced higher for longer. And that seems to me like the least likely outcome. I think either we get a rise in unemployment and rates will go lower very quickly. The Fed tends to hike quite aggressively cut quite aggressively when they do cut. So in that situation, you'd expect rates to go down to 3%. Or the economy remains resilient, there's a risk of a reacceleration of inflation, and then the Fed is forced much higher. I think it's much more likely that we get a recession because policy is now restrictive, and that restrictive policy is destroying demand. So I think from here, we're definitely going to get a hike at the July meeting. It could be the last hike, but from there, you're really, really watching the unemployment data to see what happens.
I mean, Skylar, I'm just looking at this market really picking up steam when it comes to this Treasury trade 2-year. You can see it on the screen in front of you. Now up some 10 basis points when it comes to the down rather 10 basis points. Wow, if I can find my words, when it comes to the front end of the curve. How much further does this have to come in if this is the trade, if the disinflation trend continues? And as you say, we might even get a recession.
Yeah, I mean, it's actually interesting. We're moving very much on the inflation trade, but in terms of fixed income markets, the fixed income market moved on from inflation last autumn. And since then, reals have very much been in the driving seat. And that's put increasing attention on growth. And so the most recent spate of positive economic surprises we've seen, that put upward pressure on yields until we got the inflation print. But the problem is that as you get positive economic surprises, consensus revises up their estimates for growth. And that makes it harder to beat once again. And at the same time, the rise in real yields, that squeezes the economy even more. The higher you stay high, the more it squeezes. That restrictive policy, that destroys demand. So the higher you go in terminal, there's kind of this terminal tipping point that we talk about, where the higher you go, the more growth slows and the more cuts you need later on. And I think, right now these are counteracting forces on the long end, where growth is capping your yield, but the policy stance puts a floor until we get cuts. And so, now we're very much seeing downside momentum in yields, but there is only so low you can go until you get cuts, at least priced into the curve, if not imminently.
Skylar, when we look at kind of what's driving a lot of this economic data, it feels like a lot of folks are breathing a sigh of relief, as Dani pointed out, that risk rally that you're seeing. What is the most concerning piece of the inflationary data right now? It feels like we went from commodities to housing to wages at one point. Where's the concern now?
It's interesting because we're seeing a broad-based move in inflation coming down in terms of, yes, we always knew that the easy part of inflation would come off in terms of, we always knew that energy prices would be a drag at this point. We knew that would feed into other components, and that, was very evident early on in the data. What we're seeing now is actually core improving as well. And so I think those are creating this kind of disinflation mirage that will allow the Fed to cut when we get unemployment rising. The problem is what happens after that in terms of, I think policy will have to be reactive to the fact that inflation in the coming cycle, so in the post-COVID cycle, will be higher than what we're used to. And I think that's a combination of kind of the debt, demographics, and deglobalization that we've talked about sustainably in terms of, those are all indicating inflation averaging around 3% in the coming cycle rather than below 2%, which is what we're used to.
So Skylar, then focus to us on kind of the lag here. Torsten Slok over at Apollo Global Management had made the point that the one thing that the markets are missing here is the 12 to 18 month lag that traditionally follows. So if you're worried about employment, for example, that effect is not going to show up until, say, 18 months after the Fed is done tightening. My question to you is, does the lag still matter, or is the lag still even that long?
I think, the lag definitely matters in terms of we've had aggressive tightening very quickly. And so you're definitely seeing some of that tightening feed in. Policy rates are restrictive and that real rates have gone positive, and they've been positive for quite a while. And the longer you have positive real rates, that more that feeds into the economy. And so the longer you go from your first hike and you let those hikes that have accumulated feed into the economy, the more of an impact that has. And that's why, even in a soft landing scenario, and even according to the Fed dots in 2024 and 2025, you get cuts eventually. Because what happens is, as you have inflation come down back to target, if your nominal rate stays where it is, real rates increasingly rise mechanically. And so that tells you that, no matter what, there is somewhat of a lag, and that feeds in eventually. And so I think, you just get this increasing squeeze, and whether that's shorter or longer, we'll see that come out in the data. But right now, there has been more resilience than it was expected. And so you'd think quite a lot of that still needs to feed in.
Skylar, how sustainable is a dollar downtrend? And if it is sustainable, against what currency would you want to bet that the dollar is going to fall the most?
I think right now it's really hard because there are a huge number of cross currents, and especially when you consider the major cross, which is euro dollar. So the balls can point to two scenarios for the economy. So the bulls would either go, there's a hard landing that would create a safe haven bid for the dollar, or U.S. growth resilience, meaning the Fed has to do more than what's priced in. And that's been characterized kind of as a no landing scenario. I think the bulls can also point to the very high carry you get, as well as a faltering Chinese recovery. But, the most compelling argument is that this rebound in economic surprises, especially when compared to the drop in European economic surprises, that very much points to dollar upside. The problem is the bears have a bit more ammunition in that the view is largely dependent on a mild U.S. recession and moderating inflation, allowing the Fed to cut rates. And that's what we're getting come through now. And I think the biggest point is what we saw yesterday was that U.S. has made significant progress on inflation. There's also a significant overvaluation to the dollar and a slow shift away from kind of this dollar dominance. You're also seeing balance of payment trends move away, and this risk asset resilience is also more positive. Yeah. And I think, that compelling argument, it's winning out right now. The problem is things are getting a little bit more hard on the other side in terms of Europe is looking increasingly weak. And as you approach key supports in DXY of 100, I think you'll need much more momentum to break that.
Skylar Montgomery Koning of TS Lombard, thank you as always for walking us through the eco story. And sticking with the inflationary theme that she was just talking about, we're going to talk about another aspect coming up on the show. A bad apple. The company is accused of bad faith negotiations during U.S. retail contract talks. It's just the latest in a slew of labor negotiations across the country. More on that next. This is Bloomberg.
I see the UPS negotiation as a bellwether for all the other strikes that could be on the horizon, which the issues are strikingly similar. It's about workers feeling taken for granted, having sacrificed through a pandemic, workers feeling disrespected, knowing that they have sacrificed for these companies, and yet in an era of record profits, that these companies can't find just a little bit more to take care of the people who are making them successful.
That was Liz Schuler, president of AFL-CIO, the largest federation of unions in the United States, speaking on Wall Street Week. You can catch that full conversation 6 p.m. New York time on Friday. Look, she hits a crucial point on those potential looming labor strikes, companies failing to meet workers' demands. You're seeing it in UPS, the automakers, Apple, the LA port negotiations. It just gets bigger and bigger. Let's get a little bit more insight from a true expert. Bloomberg Industry Group labor reporter Ian Colgren joins us now from Washington. Ian, the UPS Teamsters negotiations seem to have really changed the game in terms of how unions across the country, across sectors, negotiate at a time that they need to keep up with inflation.
Yes, it's true. Everyone is really looking at the Teamsters negotiation with UPS as a test of how much organized labor can get in this economy, especially with lowering inflation and things calming down somewhat from the pandemic, but workers still being discontent. The Teamsters sources I've been talking to as of last night told me that the talks are still broken down completely. There has not been any contact with UPS. They are waiting for UPS to call them.
I mean, not exactly a massive vote of confidence in terms of finding some sort of common ground. Ian, before we get into the nitty-gritty of some of the other kind of union conversations that are happening across the board, I want to play devil's advocate here. We've been covering the inflationary story heavily on the show. CPI now at about 3% year over year. As inflation comes down slowly, although ultimately coming down, how much weight or how much does that give kind of the corporate side to these unions who are saying our wages need to keep up with inflation?
You raise a really good point. As inflation falls, it becomes an increasingly harder argument for unions to make that they need more money to keep up with the cost of living. However, in this case, because inflation has just fallen recently, the argument from the union side is that the wages never really kept up with the inflation from the past year, from the past couple of years since the pandemic, and it's something that a gap that they are trying to close.
I mean, there's a lot, right, Ian, of different companies in the middle of union negotiations. Taking a step back, how do you look at the potential success of these talks right now? A lot of them seem to be coming up against roadblocks. How effective have unions been in the past year of getting their members higher wages?
Well, if you look at some of the big labor actions since the pandemic, one to look back to that turned out to really be a canary in the coal mine for the rest is John Deere. John Deere workers went on strike, rejected multiple contract offers from the company before coming back and getting a deal that they said was really positive for them, that eliminated a two-tier wage structure, very similar to what UPS, very similar to what the United Auto Workers are trying to do here. So there have been instances where unions have been successful. Other unions know that. They look very closely at this stuff. And they think, if they can do it, we can do it too. Whether they actually can is a different question because industries and the moving parts can be very different, but it's something that gains a lot of inertia.
Apple specifically, we have the store union there, their first unionized U.S. retail store in Maryland, accusing the company of bad faith negotiations. What do you make of what this Apple union has been saying this week, Ian?
Yes, well, this is something that the folks who have been a part of that union effort have really been bracing for since the beginning. The folks I've talked to who are involved in that union effort, the organizers with the International Association of Machinists, they never expected this to be an easy fight. They never expected Apple to fold instantly and give them what they want, right? Because this is something that is going to be repeated across ostensibly every Apple store in the country that unionizes from here on out. And so it's something that they know the company was going to be fighting. They knew the company was going to be fighting really hard, especially with how hard the company fought in Atlanta and some other stores that tried to unionize. And it's not a step that any union wants to take because it is an extremely protracted and messy process to file a complaint with the government this way that will probably not be resolved for quite some time. But I don't think it's a surprise to anybody that we got here.
Certainly something we're going to be keeping in mind with the larger story. Ian, let's talk about what kicks off today. Automakers are going to be kicking off conversations with the United Auto Workers in particular. And I feel like ordinarily when strikes come to focus, a lot of analysts and strategists say, okay, well, this is kind of an internal issue. It's not going to affect the earnings. Bank of America says something different. They're saying this could cost the automakers, GM, Ford, even Stellantis, billions of dollars. Walk us through those negotiations and what that means today.
Well, it is certainly possible that it could cost the companies a good chunk of change. And like we talked about earlier, these are not things that happen in a vacuum. A UAW source I spoke with last night told me that they are looking to the Teamsters negotiations as a roadmap for what they should do, the strategy they should take, and how they should get what they want. And both unions are really taking a militant approach to these talks, more militant than they have in the past. The United Auto Workers yesterday did not attend a traditional handshaking ceremony with the auto executives to start the negotiations, set things off in a good tone, in good faith, and instead they are taking the time to get their members ready and prepared for a strike, if that's what it takes. And this is a population of workers that has showed it's more than willing to strike. It went on strike for 6 weeks in 2019. It was the longest auto strike in U.S. history, and they say it's something they're prepared to do again if necessary.
Yeah, that contract ending, I believe, September 14th. Ian Colgren all over those conversations. Bloomberg Industry Group, we thank you, as always, for waking up early for us. Coming up on the show, a look at some of the market-moving events you want to watch throughout the day. We're going to walk you through it. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London with Kriti Gupta in New York. I want to give us a quick look at what cable is doing. We are at the strongest levels of the morning. I'll show you that in just a moment. First, let me take you through the brief. We've got earnings before the bell from PepsiCo and Delta Airlines, 8:30 a.m. We're going to get U.S. PPI and jobless claims. Then in Helsinki, Biden is meeting with leaders at the U.S. Nordic Leaders Summit. He's going to be having a joint press conference with the Finnish president at 10:30 a.m. Eastern. Later, French President Emmanuel Macron hosts Indian PM Narendra Modi at dinner in Paris. Okay, let me show you the thing that I wanted to show you. That is sterling. Sterling at the moment above 130, Kriti. It's higher by about 0.6%. Really is that follow on through what we saw in the CPI report. There is a new report out about UK public finances on risky footing, according to the OBR. But this just goes to show a weaker dollar is overshadowing all of that.
Yeah, it's a trade that's really picking up steam. We know that the weaker dollar is weaker against all the major currencies, so certainly something we're going to be monitoring and keeping an eye. 131 almost on that cable rate. Pretty eye-watering if you are following that story. I want to go from the macro to the micro, Dani, and look at some of the stocks we're watching in pre-market trading here. Starting off with Disney, Bob Iger extending his contract. Now remember, in his first iteration of being CEO, he had extended his contract 4 times. It's something that's very well received by the market. Those shares higher by about 1.3%. And of course, Dani, we go from sort of media tech to definitely the tech space when it comes to some of the other stories I'm watching. Microsoft at the top of that list because the Microsoft Activision saga continues. Overnight, you now have the FTC led by Commissioner Lina Khan looking to appeal the FTC loss. They basically filed for an injunction against that $69 billion acquisition of Activision. That is a big mark in history. The FTC rarely ever appeals that decision. Looks like they are now. Microsoft shares higher by 0.7%. Activision Blizzard down by about 0.2. And lastly, Dani, you mentioned it, Delta, PepsiCo. We do have those earnings coming up, both in the green right now. And of course, the PepsiCo vice chairman joining the show later this afternoon. That's it for Early Edition. Surveillance is ahead. We've got Alan Ruskin of Deutsche Bank, Troy Gajewski of FS Investments, and of course, Torsten Slok of Apollo Global Investment. Tom, John, and Lisa will take you through the eco data ahead. This is Bloomberg.